Okay, we're going to get started today by looking at the S&P 500. You can see that the S&P is above all of the major moving averages, indicating that we have some momentum in the market. You can see that it's barely above the 20-day exponential moving average, which it has hugged since at least the crash of last year. So that's a good positive sign that the stock market is going to continue to go up. However, we do know from seasonality that the stock market usually goes down in February or it doesn't go up. So you can see the February stock market returns for the past 50 years have been almost 0.29, which is not very good. So don't get too don't expect the stock market to do much in February. And we did have a positive January this year, up 1.5%. So Strategist had did a research going back to 1950. This doesn't work all the time, but it's something to keep in the back of your mind. When the S&P is up in January, it's usually up. The rest of the quarter, it's usually up 1.65%. The first half of the year is usually up 5.5%, and the rest of the year is usually up 12.2%. We didn't have a negative January, so um, but we are looking at a February where returns may not be that great. So let's look at the front page of the Yahoo Finance. This is one of the best websites to go to for news about the stock market. What happened last end of last week? We had um, a crash in a lot of the speculative assets. So Bitcoin, gold, and silver basically all crashed down. We have, let's look at silver. You can see that silver had like a huge run up. Warren Buffett said one time that he has no interest in precious metals such as gold because gold doesn't produce anything. It doesn't give you a dividend, and it's basically speculative because it doesn't really, there's no really way to quantify what its true value is. So, so you can see that silver went down 30%. Let's look at the gold chart. A lot of times whenever stocks or commodities or whatever are in free fall, you try to get some kind of idea where the support is. And right now we have the 20-day exponential moving average of silver. It definitely blasted through that. Um, and there's a 50-day moving average around 66, 67. Let's look at the gold chart. You can see that gold went down to its 20-day exponential moving average and stopped right there, which is pretty encouraging for anyone interested in gold. Um, and all the gold related stocks went down with it. So let's look at Bitcoin. You can see it's been going down recently. Um, I have no interest in cryptocurrencies. I can't. Warren Buffett said he wouldn't buy all of the cryptocurrencies in the world for $5 or something like that. So I follow what Charlie Munger and Warren Buffett say. I'd rather invest in the stock market than cryptocurrencies. But right now, Bitcoin is like, let's look at the Bitcoin price. So you can see it's down a tremendous amount from the top. So, all right, let's look at some more talking points. Okay, we're right in the middle of earnings season right now. And we just had Microsoft, Meta, Tesla, Apple report the earnings this week. Next week, we're going to have Google, Amazon report. So stocks could go up or down lots based on how the earnings come out in the next week. So we do have a holiday coming up on the 16th, President's Day. So a lot of times the stock market goes up around ho major holidays. And we also have options expiration on the 20th of February. It's going to be very volatile. There's a lot of options expiring during that time. Um, and in March, we have a triple witching, which is a lot more volatility in options expiring. So you have to keep in mind whenever the stock market goes up or down a lot during one of those days that it's because of that phenomenon. All right, let's look at the earnings reports that came out this week. We had Boeing report, we had Microsoft report. They guided kind of low on Microsoft guided low on their Azure, um, their cloud revenues, and it wasn't good enough, and it went down 10%. And Meta went up 10%. So we had when they had better than expected earnings. And we had MasterCard went up 4% when they had good earnings. And Apple had blowout earnings, really good earnings, but they didn't go up much at all. But the earnings were awesome. So next week we have the biggest ones that are coming out are going to be Eli Lilly on Wednesday, Alphabet on Wednesday, and then Amazon on Thursday. A lot of times the big stocks set the tone for the market. If they go up, the stock market goes up, and if they go down, the rest of the stock market goes down with it. So that's why you got to keep now the good thing about Alphabet, we have noticed, let's look at the US dollar. Wait. 10-year treasury. The US dollar has been going down recently. Rats, I'm trying to find it. Okay, I couldn't find it. But the US dollar index is has been going down. So as the US dollar index goes down, so does Alphabet becomes more profitable because they have a lot of overseas sales. So we know they're going to we know Alphabet and a lot of the companies like Facebook or Meta that do business overseas and Amazon are going to get um, help from the US dollar, which is declining. Now we have Eli Lilly. They've been they have a pill that's going to be approved sometime this year. That's the catalyst for that company. They're going to have a pill that for weight loss that's better than their injectable, which is going to really be great for that stock. So we'll see what they say in their earnings. Eli Lilly's growing around 30% a year. And okay, so this is our check on the basic momentum numbers. We have 66% of the S&P above the 50-day and 64% above the 200-day moving average. Okay, so that is basically a bullish market. You see, we have a 10-year unchanged from last week, but if we look at our 10-year chart, you can see we're increasing the interest on the 10-year. So there's a whole lot of ramifications for the increase in the 10-year yield. So let's look at, okay, what else is we're gonna look at? Okay, we're gonna look at, we know we're in February, which is not a great month for the stock market, so don't get your hopes up. And okay, in the S&P, we're basically above all moving averages, but halfway between our trend lines. So we're in like in the middle of nowhere right now. We're overbought. So it's a prime time right now to not buy and to just wait because we are overbought right now. So let's look at the 10-year. Okay, the 10-year is going up. So our let's look at our cheat sheet. Hold on for a second. It'll be worth it. Okay, the yields of the 10-year going up. It's positive for tech stocks because the big tech stocks don't need to borrow money. Um, it's positive for financial sector, insurers, and banks. It's negative for any company that needs to borrow money. So small cap stocks, heavily indebted stocks, because the cost to refinance and borrow goes up as the interest rates go up. Um, high yielding stocks, um, it'll be negative for high yielding stocks because there's a less demand for high yield stocks if the guaranteed return of a treasury yield goes up. And of course, home builders, it's not good for because the cost of mortgages go up as interest rates go up. All right, let's go back to our talking points. Okay, so the price of oil is up just a little bit. Um, it's up 6% since last week. And the US dollar index hasn't changed since last week. Gold is down 3%. So we had a sell-off on speculative assets, and gold right now is kind of lumped into the speculative assets um, area. Let me see. Okay, now let's look at our fear and greed index. The fear and greed index is greed. So our translation is when the stock market in general is greedy, take some profits off the table or don't buy. And we also have greed in the AAII individual investors survey. So it's the same thing. Whenever people are bullish in the stock market, it's time to take some profits off the table and don't buy. So we know we're overbought and we're going into one of the worst months of the year, and everyone's bullish right now. So that you have to think as a contrarian, the opposite, that most likely the next step is down. Okay, so the VIX right now, it has been going up. It's up 17 from 16. So people are starting to fear a little bit in the stock market, but it's still um, relatively low, meaning people aren't that afraid. And we're still in the greed phase in our emotional chart. Perhaps sometime in February, we'll get to a fear and where people are starting to sell stocks and be fearful. That is the time that Warren Buffett buys is when people are in capitulation and despair. Um, okay. Okay. So right now we are at an all-time high valuation for the average stock in the stock market. Um, so the interesting thing is that we are having consistent 14% growth in the S&P. So it seems like we're trading at a high premium, but we are still growing 14%. Um, so that's like a phenomenon that we didn't have back in 1965 or 99 when we had this same high PE ratio. Okay, let's look at our first to worst. And this is actually working out pretty good this year. So the best performing sectors last year, communication services and IT are some of the worst this year. We have IT as negative 1.3% total return. And the worst ones from last year, energy is actually the best one for this year. It's up 14%. Um, so that's just a good lesson that you got to be diversified. And whenever one sector is in favor, sometimes the next year other sectors will be in favor. So a diversified portfolio, you can follow this line here. A diversified portfolio will return usually more than if you invested just in one of these individual sectors over time. So let's go back. Okay. So what other sectors are doing good? Materials, and we have energy and consumer staples um, in industrials. So that is, and healthcare hasn't done anything this year. All right, so that's a good first to worst lesson. Um, the PE valuations relative to history. I like to look, you can click this link and go there. I like to look at this just for an idea of the sectors that might be undervalued right now to start looking to buy something in. So we see right now financials are the most out of favor. And we have energy, utilities, and real estate. And it seems like real estate is at the mercy of interest rates right now. But utilities are out of favor, energy, healthcare. So when I'm doing my stock market screens for stocks that are good stocks, I expect to see financials, real estate, and utilities, energy, healthcare in the top 50 stocks that come up, and they are actually starting. I see a lot of those in our screens as undervalued. Um, the most overvalued ones, consumer discretionary, IT, and industrials. These wouldn't show up as much in the screens for stocks to buy. So let's look at the stock screen for this week. Um, of course, what I did here is I sorted each of these categories based on how on and I made the best performing companies green, and then the best 30 green, the next 30 yellow. So you can see that I tried to find as many um, green and yellow combinations that look pretty good, and combine that with having a low peg ratio. So you can see that GE Veranova turned out to be a pretty good fit. It's growing its forward long-term EPS growth at 67%, return on equity at 52. But going back to our theme of looking for the best stocks in the sectors that are undervalued, we expected to see energy, utilities, real estate, and financials. Let's see if we see that. There are a lot of financials in our screen. We have JP Morgan, Bank of America, um, Morgan Stanley, Goldman Sachs. So we do see um, a lot of these sectors showing up as undervalued. So as a value investor, this is the time that right now these sectors are out of favor. And those are the times that Warren Buffett would tend to pounce on stocks that are unloved, but have a 20-year time frame of continuing growth. So you can see that let's get some examples. Eli Lilly is like almost fairly valued right now, and they're going to have the earnings come out. We have JP Morgan. They're down with the financial sector, which is in a downtrend right now. We have Bank of America. Okay, so you can see that we have a lot of these energy, utilities, real estate, and financials in our screen right now. We have the TD Bank is a bank, financials, Blackstone, kind of a financial, and Barclays Financial, Robinhood Financial. Okay, so you can see that we have more financials than anything else on our screen right now. And I target in my screens, I target the stocks with the lowest PEG ratio. And because then you know that you have a good basis for um, investing. A lot of times you have to have a margin of safety when you're investing because even if you buy a stock that's undervalued, it can get more undervalued tomorrow. So at least if you buy it for half off, then if it goes down, then at least you have that margin of safety of 50% um, for a little buffer area. All right, so that's a good lesson learned. Let's go back to our talking points here. Um, you can see the energy sector is the best performing sector now. Materials, consumer staples, industrials, communication services, and real estate. The worst sectors are S&P financials, IT, and healthcare. All right, so I like to look at this every week because it's really, really important. And um, 125 years of market history, stocks and earnings move together with a 98% correlation. This short run is all about noise. The short run is all about noise. The long run is about profits. Speculators chase noise and investors follow profits. So that's why whenever we're doing our research, we follow the profits. And that's why whenever we're looking and are doing our screens, we look for the earnings estimates going out multiple years. And usually the stock price follows the growth in the earnings um, over time. So let's continue to look at that. And this is also what I like to look at on a regular basis. The US dollar is losing money, losing its purchasing power over time. So having cash in the bank isn't that great of an idea right now because um, the dollar that will buy you a banana this year will not buy you a banana in 5 years. It'll buy you a half banana. So you have to invest your money in into things that are growing greater than inflation. All right. So let's look at some of the stocks going up and down today. Okay. You can see we have Deckers, Verizon, Charter, SanDisk. We'll go over SanDisk a little bit later. SanDisk is a memory producer, and right now they make NAND memory for that's used for data centers and for personal devices. So this is very similar to Micron, um, the business model and what they sell. So we're going to go over SanDisk and kind of compare it to Micron a little bit later. We have Colgate. So we have a theme right now of high dividend. We have Telecom, Verizon, AT&T, T-Mobile in the top performing. And we have you see consumer staples. We have Church and Dwight. And okay, that's the thing. The ones going down the most, AppLovin, K-Lite, Tencor, Newmont. Okay, so we have a gold. Um, Newmont mining is gold, and that follows the price of gold, and gold tanked with silver on Friday. We have gold manufacturers like Freeport McMoran. Um, they're a gold miner. And okay, a lot of these are semiconductor related suppliers. So K-Lite, Tencor, they make equipment for making semiconductors. We have Advanced Micro Devices, a semiconductor company. Lam Research, they also do products that help make semiconductors. So that whole and AppLovin has been a stock that went up a lot last year, so that's just giving some back right now. Okay, let's look at the sectors going up and down. So we know from the 10-year, it's been going up. So we are following our pattern right now of um, gold. The price of the gold commodity has been going down. So all the gold related stocks go down with it. So even the best run gold company is going to go down 12% when the price of gold goes down 12%. So that's what is tricky about investing in stocks um, that are dependent on a commodity. Okay, so let's look at the other sectors that are going down. We have semiconductor. We have, I think what happened in the semiconductor world is when silver and all the and gold and a lot of the speculative assets went down, some of the high-flying semiconductors went down with them. So some profit taking. And we have home builders. Okay, as interest rates go up, the demand for homes go down because the price of mortgages and paying a mortgage goes up. So yeah, that makes sense why home construction is going down. Biotech, they need to borrow money as the interest rates for the 10-year go up. Biotechs aren't as profitable because they have to pay more for borrowing money. So our theme of stocks that need to borrow money um, going down is panning out today. Okay, price of commodities are going down a lot on Friday. So um, oil has gone down with it. Let's look at the ones going up the most. Consumer staples, energy. Okay, these are oil and gas, healthcare. Okay, these are conservative sectors. When the stock market is going down a lot, people gravitate away from the speculative and they go towards the more conservative. So these are all conservative sectors, and the sectors that are part of this sectors that are undervalued also. So that was a good little exercise. Okay, let's go back to our talking points here. Let's look at the announced picks um, from this year. Um, PI, this is Impinj. We saw the financials weren't perfect whenever he first bought it. It's down 20% right now. And Apple is down 5%. Nike is down 3%. Cisco is up 2%, and Boeing is up 4%. So I guess the lesson learned here is he went with Dan Niles went with some tech stocks. Right now, tech is out of favor. Um, so we'll watch this over time. Apple had a really good report this week, so um, that's a good reason for the stock to go up in the coming months. All right, so let's look at some charts that I picked out as pretty interesting. Okay, this is the gold chart. You can see that gold is in a fantastic run since this time last year. It's one of the best performing sectors in the S&P or in the stock market in general. But you can see that we are overbought in this gold GLD, and we went down to the 20-day exponential moving average. A lot of times when there's a big sell-off like this, um, whenever it hits a certain moving average, the algos, they start buying. And when it next stop is the 50-day moving average. And whenever that hits the moving average, there's usually a bounce. So we'll see if it bounces there. Next one is XLF. You can see this is the financial ETF. I like to look at the ETFs first because we get a hint if we have, um, right now we have support right here. It's oversold. The whole sector is oversold of the financials. And we're at the bottom end of our trend line. So that is a good time to start looking to buy financials if you're not in financials yet. So that's why I put together this um, sector chart to get ideas of what kind of stocks to buy or to look for. So we know that there's a tailwind for financial companies in that Warren Buffett knows that 20 years from now, there's still going to be a demand for banks. That's why Warren Buffett has like maybe 5 or 10% of his total portfolio in banks. It's an old school business that's not going to be disrupted easily. And also, the president is making an agenda for allowing mergers and acquisitions, and that's going to help the bank's profitabilities. And a lack of um, rules to follow for the banks. They're going to make it easier for banks to do business. So we'll see this year if financials do well or don't do well. Okay, next chart is the XLE. You can see that we way back here in April of last year, we started this uptrend, and we are in for it's this sector is up 14% this year. And a lot of these stocks in this XLE um, have PE ratios less than 10. So they're still undervalued. And when we saw from our valuations list, let's look at it again one more time. It'll be worth it. There it is. You can see that energy is one of um, the valuations relative to history. It's a low valuation. So we have very low PE ratios and low expectations for the energy world. And that's that's a good time to start looking into those kind of um, stocks for your portfolio. All right, let's go back to our next one is Google. You can see that this is one of the strongest stocks right now in the stock market. It's overbought right now. One good catalyst for this stock that not a lot of people think about, they own 14% of SpaceX. And SpaceX currently has a valuation of 1.5 trillion. So let's look at that's 1.5 million, billion, trillion times 0.14. Okay, so they they own 14% of a $1.5 trillion company. That means they're going to realize a gain of $210 billion on their next earnings report for that investment. And also, SpaceX is supposed to come out, supposed to IPO sometime this year. Um, the other things, great things about Google is I think they figured out a good solution for AI, and and they also have Waymo, and they have a lot of new investments that aren't really into the price of the stock. They have a cloud business that's growing like 30%. So they have a lot of irons in the fire in autonomy and robo taxis are just growing like wildfire. So I think it's really hard to know buy and hold a stock for a long term, but this seems like a stock that's very robust and can continue to grow like 10% a year. So I'm going to keep an eye on that one. Okay, let's look at Apple. Apple is down pretty consistently for the last 8 weeks. But you can see that we have this uptrend in place. They just came out with really good earnings. They didn't go up a lot like the other stocks that had good earnings. They're oversold, they're overbought right now. Um, but they're starting to get close to their moving averages. So they are a little bit overvalued right now. So anyways, I like to look at it as I'm buying I bought this in 2012. So what I do as a long-term investor, I see that they're still growing around 9% a year. They're overvalued right now, but they're still growing at 9%. And um, and they have a new AI addition to their phone, which could be a catalyst for more sales. They had really good China sales recently, and that was a big reason why it didn't go up before. So it seems like they have a lot of catalysts. People could upgrade um, because of the AI. I think that could be a reason to upgrade. They just can't make enough iPhones right now due to memory shortage. So that's kind of a limitation. All right, so let's look at another stock, JP Morgan. You can see that it's been in an uptrend for a year now, and it's oversold right now. You can see it's oversold, and it's at the bottom end of its trend line. Um, let's see if it holds right here. I'm not sure. I bought this a long time ago, and it's growing around 10% a year, and it's a good way for me to diversify into financials. Um, yeah, I already talked about this stock screen that we did, and like I said before, I made the top 30 in every category green. And whenever I eye up you see, hold on. Whenever I eye up stocks to buy, I like to look at the stocks with a lot of green. That means the best in each category. And then kind of line up with the sectors that are out of favor the most. You can see that I didn't really go into this one this week, but EQT, they're an energy company. They're like half off, growing at 30%, and their cash flow growth rate is 46%. We'll have to look at this one next time, but a lot of times whenever I'm looking for things to invest in, I try to get ones with green the whole way across the board or close to it. And then that's like a beginning for me to start looking for a good stock. The most important thing for me is the PEG ratio, and that gives you a real good idea of it's half undervalued if it's 0.44 PEG ratio. And okay, so that's what I did was I saw this GE Vernova. I thought it'd be interesting to look at it because it says um, the PEG ratio is zero point 0.6, which is almost half undervalued. They're growing, their long-term growth rate is 67%. Return on equity is like 3 times greater than we want. So it looked pretty good. I thought it'd be interesting to go over GEV. GE Vernova, they are a company that makes gas turbines for um, for AI data centers or data centers in general. So there's a big demand right now for electricity for AI data centers. And they had a really good earnings call and they said there's a lot of demand for what they make. I look at the earnings projections. They seem like they're growing at 56% and their PE ratio is 57. So that means their PEG ratio is 1. They're growing at 60% and their P/E ratio is 57. If you divide 57 by 60, it's 1. So that means they're fairly valued. The profit margins are just what we're looking for, and the return on equity is 3 or 4 times what we're looking for. And they have more cash than debt. So this checks all of our um, necessary, you know, um, criteria for buying a stock. And they're and they have a high free cash flow. So all in all, this looks like a really good stock. I like to bookmark this. If I'm fully invested, I like to bookmark it and wait for it to sell off because, with a PE ratio of 60, a lot of times it's a very volatile stock and it'll go down. And we have February coming up, which we know is a very volatile or not a very good month. So there's a very good chance that we're going to have some volatility that'll allow us to get this at a lower price. So it's fairly valued right now. Let's watch it and see if it gets to be undervalued. Um, okay, so this is CFRA research. They say that let's look at what they said in their investment rationale. Our recommendation is a four-star buy. GE Vernova is well positioned to benefit from secular tailwinds from rising electricity demand supported by data centers, AI, and manufacturing trends. The company maintains a lead in gas turbines with long-term agreements with Chevron, NextEra Energy for power plant development. We favor the high percentage of recurring service revenues and significant backlog providing ample visibility. So it sounds like this is a company that has contracts in place, so it's almost guaranteed that they're going to meet their earnings report every every month or every quarter because they have contracts in place and um and they have guaranteed sales. So that's really good. And let's look at what the fair value is. CFRA says the fair value is a little bit more than where it is. It's undervalued by 5.8%. That matches our PEG ratio of 1 whenever we did our calculations. So they think it's fairly valued also. Let's look at what Morningstar said. They said it's 20% overvalued. They said, yeah, they basically think it's just a little bit over 20% overvalued. So that gives us a little, I don't think Morningstar is as good as CFRA. So, but it's always good to know that it's fairly valued, a little bit overvalued. So combining with CFRA, I would say let's wait for this to drop like 20% and then start dollar costing into it because it's fairly valued now. It's not really, we don't have a margin of safety yet. So let's wait for it to go down 20% and then we can start dollar costing into it. Okay, here's a story that came out. SanDisk stock price surges in pre-market after upbeat forecast. Okay, so this is example of whenever we've been following Micron, and Micron is a stock that makes memory chips and high bandwidth memory for AI data centers. And this is a company that's as close, it's a very close um, competitor. So whenever the competitor comes out with excellent news and they go up 20% on their earnings report, you got to keep that in mind because Micron will probably have the same demand and same kind of um, supply demand. I mean, the same kind of demand for their products. And so we have the sales jumped 19% pre-market, and they boosted their profit forecast and renewed a crucial supply deal. So I thought it'd be interesting to review SanDisk again, kind of compare it against Micron um, to see this sector and to see if this stock is one we would look at. Um, SanDisk is growing from last year to this year, 1,156%, which is amazing. They had $2 earnings in 25, and then they have 334.69. So I guess um, that is just an amazing amount to grow. But from this year to next year, they're growing 108%. So right now their P ratio is 44 and they're growing 108. So that means they're half priced right now. The only problem is that their profit margin is negative 11 and the return on equity is negative 9. So it doesn't have Micron's profit margins are a lot more than this, and the return on equity is positive. So Micron is a better of the two for operating margin and return on equity. The total cash, they don't have a problem with that because they have a net cash and they're making money, 121 billion free cash flow per quarter, per year. So let's look at what Morningstar said. They said they're 14% undervalued and warp speed demand for NAND pricing growth. So basically, they have pricing power for their memory and what they sell. So that means they're probably going to increase their prices over time. They're sold out of what they're selling. So that's a really good indication that Micron will have a very similar demand for what they sell. And CFRI didn't give me a very good report. This is like junk report. They usually give junk reports to companies that are smaller or they don't want to pay, they don't want to do a lot of research on. So, but let's look at the chart of Micron compared to SanDisk. It's almost identical. If you look at it, um, SanDisk went up a lot more than Micron, but they basically have that exponential demand for what they're selling. Okay, let's look at the top holdings of a well-known mutual fund, T. Rowe Price Science and Technology Fund. And this is the symbol here. And the reason why I do this every week is um, mutual funds have unlimited resources and for research. And usually when they buy a stock for their portfolio, they hold it for like 10, 20 years. And for me, my method of investing is buying and holding quality stocks for the long term. And I like to see what the current holdings are for some pretty smart mutual funds. And so we're going to go over, what they're holding right now. NVIDIA is number one position. Microsoft, Broadcom, Apple, Meta, Alphabet. We have Class A and Class B as C. That means Alphabet is actually their second biggest holding because if you combine the A and C, that is very near Microsoft there, right here. So Palantir, Salesforce, and Lam Research. You can see Micron is actually in 11th position. A AMD. So this is very big on semiconductor sectors, and you can see. Look at this. This is interesting. They just established positions in Adobe, Intuit, and Accenture. And this is a consulting company. Um, a lot of the software companies are being thrown out like a baby with the bathwater. They think that Adobe companies that do software are going to be um, taken over by AI. So we'll see if that's a good. I'm wary of Adobe. Also, Intuit, they made a product this year that's doesn't work with Windows 10, which is really stupid. They have their TurboTax product that they make people buy Windows 11, and 90% of Windows computers in America run Windows 10 right now. So they're gonna have their sales in TurboTax this year, I think. So I wouldn't buy into it. Um, all right. So that's a really good so whenever the reason why I bring up this top holdings of mutual funds, um, my portfolio looks a lot like this, a lot like buy and hold stocks. Most of these stocks, mutual funds are not going to sell over time. They're going to buy and hold them because they get penalized for selling out of stocks and getting into the other ones because they're people that hold mutual funds um, try to get mutual funds with low turnover ratios. So why would they buy IBM? IBM is actually turning from a mainframe company to a service company. They bought Red Hat and now they're making quantum computers. So they're going to have a functioning quantum computer by 2030. So they are a very innovative company, even though they're really old. They are they're building they're more of a service-based high margin business. So let me see. Okay. Well, it's always good to check the top holdings of major mutual funds and hedge funds. All right. Well, I hope you enjoyed that talk. Um, um, and I hope you have a good investing week. I'll see you next time.